Hello and welcome to this podcast. This podcast is the first in a series in which we identify and examine the different elements of the gross income definition. Gross income is significant because in many ways it's the starting point for all tax. If you don't have gross income, then simplistically speaking, you don't have any taxable income against which you have to pay tax. So we're going to have a look at the gross income definition, and in this podcast we're going to focus on the definition of resident. So gross income, in terms of the definition in section 1, means in any period or year of assessment. In the case of any residence, the total amount in cash or otherwise received or accrued to or in favour of such resident, or in the case of any person other than a resident, the total amount in cash or otherwise received or accrued to or in favour of such person from a source within the Republic, during such year or period of assessment, excluding receipts or accruals of a capital nature, but including ... and that's where the special inclusions come in. So the first thing that we can see is there are two different definitions, one that applies to residents and one that applies to persons other than a resident. So in this podcast we're going to deal with what is a resident. From that definition we can see that a resident must include their worldwide income in their South African gross income. A non-resident, however, only includes income from a South African source. Residence is determined by, in the case of individuals, firstly, whether or not that person is ordinarily resident in South Africa, or if they are not ordinarily resident in South Africa at any point in the current year, by the physical presence test. Now, if they are ordinarily resident for any part of the year, we don't go on to the physical presence test. So the physical presence test is only for people who are not ordinarily resident. So what does ordinarily resident mean? Well, there have been a number of court cases where this has been debated, and the key elements are the following. Being ordinarily resident in South Africa is not the same as being a citizen of South Africa. It doesn't mean you've got a South African ID document, it doesn't mean you've got a South African passport, it doesn't mean that you own property here. It has got nothing to do with any tick box exercise that you could say, I want to be a resident or I do not want to be a resident for tax purposes. In the following two cases, the court has essentially said that whether or not you're ordinarily resident is a question of your state of mind. And in Cohen, the court said that the country in which you're ordinarily resident is the country to which you would return from your wanderings. What happened was Mr. Cohen was a director for OK Bazaars and he was sent over to the United States, and while he was over there he earned interest and royalty income from South Africa. He argued that since he hadn't been living in South Africa during the year of assessment, he couldn't be ordinarily resident. The court looked at his circumstances and said that it was quite clear from his circumstances that it was always his intention to return to South Africa. He had only been sent initially for 9 months. Those 9 months had been extended by a further 12 months. But it was quite clear that he was going to come back to South Africa. The place to which he would return from his wanderings was South Africa, and while in the United States, he was essentially on one of these wanderings. CIL versus Cattell was the opposite. Cattell was also sent by his company to the United States, and he was to explore business opportunities there. But unlike Cohen, he settled much more permanently in the United States. He rented property there, he bought a car, he opened bank accounts, he joined a church, he obtained a social security number, and eventually he actually became a resident or obtained citizenship in the United States. And although SARS tried to argue along the lines of Cohen where they'd been successful, in Cattell's case the court said it was clear that Mr. Cattell had changed his country of residence. He was no longer ordinarily resident in South Africa, but the place that he was now habitually and normally resident was the United States, and that was the place that he was ordinarily resident. So it is possible to remain ordinarily resident in South Africa even if you're not physically in South Africa, and likewise it is possible to change your country of residence even if you were not born in that country originally. If you become a resident under the ordinary residence test, or if you cease to be ordinarily resident, then you are treated as resident or ceasing to be resident from the date that those criteria apply or cease to apply. So on the day that you become ordinarily resident in another country, you are stopped being treated as a resident in South Africa. The fact that you might have occasional absences from your country of residence does not mean that you are no longer ordinarily resident in that country. And likewise, whether you are ordinarily resident or not has very little to do with the number of days that you are present in the country. So that's the ordinary residence test, and we'll have a look at a few examples. So for instance, Mr. X lived in South Africa throughout the 2012 year of assessment. On the 1st of March 2012, start of the 2013 year of assessment, Mr. X moved to New York on an 18-month secondment. He will return to South Africa at the end of 18 months. Is Mr. X ordinarily resident in South Africa? I think we can see from the debates of Cohen and Cattell that he remains ordinarily resident in South Africa. In contrast, Mrs. Y lived in South Africa throughout the 2012 year of assessment. On the 1st of March 2012, Mrs. Y left South Africa to take up a new permanent employment position in New York. Mrs. Y sold her car and her house, bought a house in the suburbs surrounding New York, and enrolled her children in school there. Is Mrs. Y ordinarily resident in South Africa? I think there we would say no. Her example is more like that of Cattell than it is of Cohen. And finally, Mr. Z has been in South Africa for the past 2 years. He's a professional soccer player, and this year his application for citizenship was fast-tracked so that he could represent the South African national soccer side. He is now a South African citizen. However, he intends returning to his home country as soon as his international career is over. Is Mr. Z ordinarily resident in South Africa? This one is a little more difficult, and I'm not going to tell you what the right answer is. The two things that I do want to point out, though, is the fact that he obtained citizenship in South Africa does not automatically mean that he is ordinarily resident in South Africa. Likewise, the fact that he intends going to some other country at some point in the future, even his home country, doesn't automatically mean that he is still resident in that other country. He must have some practical link to his home there. It can't just be a wish, a hope one day that those are his plans are. We must be able to say, if he was to return from his wanderings, where would he consider his home? So that's ordinary residence, and ordinary residence is a state of mind. You can see from that, though, that it might be easy to manipulate where you're ordinarily resident. And you could make sure that you're not ordinarily resident in South Africa in order to avoid paying tax in South Africa. So, the second test was introduced, and that's the physical presence test. The physical presence test has nothing to do with your state of mind. It is a matter of fact. It is only used if you were not ordinarily resident at any time during the current year of assessment. If that is the case, you may still be treated as resident if you were physically present in South Africa for 91 days in the current year of assessment, or more than 91 days in each of the preceding 5 years of assessment, so you have to be in South Africa consistently for 6 years, and more than 915 days in aggregate in the preceding 5 years, so excluding the current year. If you divide 915 by 5, you'll get 183 days. So we're saying on average, you must have been in South Africa for more than 6 months in every year in the past 5 years. If you meet all 3 of those criteria, you will be treated as resident from the beginning of that year. And you'll be treated as resident until the end of that year. That's different from the ordinary residence test. The ordinary residence test can begin or end in some point during the year. Physical presence test, if you meet the physical presence requirements, you're treated as resident for the whole year. The only time it could be less than a full year is if you leave the country and you remain outside the country for at least 330 continuous days. Then you will cease to be treated as resident from the day that you left. Really what you're saying there is, I've left and I'm not coming back. So the way that I'm treated should now change. Let's have an example of the physical presence test. So Mrs. P was ordinarily resident in South Africa from 2008 to 2011. In 2011 she moved to London, where she has lived for the past 3 years and where she is considered ordinarily resident. So we know that she's ordinarily resident in the UK. However, every year she returns to South Africa to spend the summer here. 2 years ago she spent an extended period of time here because her mother was ill. Her time in South Africa has been as follows. 2008, 9 and 10 she was here for the full year. 2011 she was here for 185 days, and that's when she moved to the UK. In the 2012 tax year, she was here for 101 days, and in 2013, she was here for 93 days. Is Mrs. P resident in South Africa for 2013? And if so, for what proportion of the year? Well, we know that she's not ordinarily resident in South Africa because they've told us that. So we have to apply the physical presence test and say that she was in South Africa for more than 91 days in the current year of assessment, more than 91 days in each of the previous 5 years of assessment, and more than 915 days in total over the previous 5 years of assessment. Therefore, she is treated as resident in South Africa in 2013, and because it's the physical presence test, she will be treated as resident for the whole tax year. Secondly, would Mrs. P have been resident in 2011, and if so, for what proportion of the year? Well, 2011 was the year that she moved from South Africa to the UK. So she would have been resident in 2011 because of the ordinary residence test. And because we're applying that test, she would only be resident for a portion of the year. That would be the 185 days until she changed her country of residence. So those two parts to the example highlight the difference between the physical presence test and the ordinary residence test. So far we've had a look at residence of individuals. Let's have a look at residence for companies. A company is resident in South Africa if either of the following two apply. If it was incorporated or formed or established in South Africa, then it's resident in South Africa. Or if it has its place of effective management in South Africa, then it's resident in South Africa. Now there's two opinions as to what this place of effective management means. Everyone agrees that place of effective management means where your management decisions are taken. So not decisions like what dividends to pay, directors to be appointed or fired, not where your AGM is held, where your business decisions are taken. But from there on, there are two opinions. SARS takes the opinion that it's where your day-to-day management decisions are taken. What stock to buy, what suppliers to use, what prices to charge. The decisions that are closely linked to the actual day-to-day operations of the company. SARS likes that approach because it's very difficult to separate that from the physical location of the operations themselves. The OECD model is different. The OECD believe that the place of effective management is where your top decisions are taken, your top management decisions. And that's a little bit more easy to separate from your actual operations, and so for that reason SARS don't like that approach. We know that SARS would apply the approach that I've highlighted to you. We don't know for sure whose interpretation is correct because no one has ever gone to court to test this. So for now, we have two possible interpretations. There are some exclusions from the definition of resident. The one that I'm going to highlight to you is the first one on the slide, and that is if you are deemed to be exclusively resident of another country in terms of a double tax agreement between South Africa and the other country, then you will be excluded from the definition of resident in South Africa. That's as far as we're going to go on residence. If you are not resident in South Africa, then you are only taxed on your South African source income. So in the next podcast, we're going to have a look at what South African source income means. Thanks for watching.